Are you thinking about dropping a price of your home, or if you're a real estate agent, dropping the price of one of your listings? If you are, and the goal of that is obviously to sell the house or attract buyers to sell the house, there is a different strategy to consider. And that is in lieu of a price reduction, or maybe it's not just price reduction. It could be a combination between price reduction and a seller credit to help bring affordability to market. So here's a strategy that honestly the new home builder space has perfected. And they are essentially moving their inventory by offering very large seller credits to buy down interest rates to help buyers see affordability with their product that they're selling. And so I'm advocating that we can do a similar thing on the retail side of the business. Now, can we throw as much money at it? It depends. It depends on a lot of different factors. That methodology of, in lieu of price reduction, using a seller credit towards the buyer's closing costs so the lender can use that money to bring affordability to that buyer, and hopefully a strategy to the buyer where they can see themselves in that payment and your home. All right, so here's kind of how it looks. On average, in today's market, kind of think for every $10,000 that you drop the price of your home, the payment savings to the buyer is roughly $60. So $60 for every $10,000 in a price reduction is about what you're seeing today. So the thought is, if you're going to drop your price by roughly $30,000, assuming it's a $550,000 purchase price, you're going to drop that price $30,000. Your buyer would see a $180 price improvement or payment improvement or lower payment per month. That's how the math works. Now that's pretty standard. We see that a lot in the resale market. But I'm advocating, let's kind of look at the numbers a little bit different, which I'm going to dive into here. We're going to really look at a chart where we can map out and see side-by-side comparisons of the math and what's really happening with each one of these strategies. All right, let's dive into the numbers, because this isn't just a theoretical type of conversation. This is real numbers in a scenario for a particular price point. So what I'm showing you on the screen is a tool that we use to really be able to show side-by-side analysis and different strategies, because there isn't just a one-size-fits-all in mortgage lending. So here we're going to show 4 different strategies, keeping in mind that the house is currently listed in this scenario at $550,000. Now, the principal and interest without any seller credit or price reduction, together with mortgage insurance and property tax estimate and homeowner's insurance, on a $550 purchase price with 10% down, which is not shown here, but this is important to know that that total payment is right around $37.64 a month. Okay, so that's just kind of, you have the house listed at $550. A buyer comes along, they're going to do 10% down, assuming good credit and they can qualify and all that kind of stuff. That's a payment that they could essentially estimate as reality. But your house isn't moving and you're like, gosh, I'm thinking about dropping the price, or I'd like to explore different strategies. Well, that's what this does. All right, so the first column is, let's assume that based on conversations you're having with your real estate agent and what's taking place in the market or not taking place, you decide, hey, I think I'd like to throw $30,000 at this. And I'm saying that because we're going to use that $30,000 in various ways throughout this exercise. Column 1 is going to show taking that price from $550,000 and simply just reducing the price by $30,000. No seller credit towards the buyer's closing cost in this scenario. That's going to yield a total monthly payment. Again, this includes property taxes, homeowner's insurance, mortgage insurance based on a 10% down conventional loan. That brings our payment down to roughly $35.80 a month. So in that scenario, it's again roughly this kind of $60 for every $10,000 price reduction. So roughly $180 a month. That's the savings with that scenario. Okay, let's move into scenario 2. Let's say, hey, instead of throwing the full $30,000 that I've allocated to spend, what would it look like if I dropped the price by $20,000 and then gave a seller credit of $10,000 to help the buyer buy down the interest rate or cover their closing cost. So in this scenario, what we are doing is showing you how a lender could spend that $10,000 seller credit to actually buy down the interest rate. So in this scenario, now that payment drops to $34.47 PITI a month. So you can see the difference between the $30,000 price drop and using that same $30,000, what it's yielding every month. So it's an additional, roughly, call it $120 a month. Again, this is what's impacting the buyer on a monthly payment basis. And in conversations, especially in this interest rate market, it's all about payment. It's all about just, can the buyer afford, can they qualify for that payment, but can they afford it? Can they get their arms around it? Can they process that payment? So the strategy is helping to bring a lower payment to market with the hopes that this type of approach will help sell your home. Now, when we go into the third column on this analysis, you're going to see that I'm looking now at, in lieu of any price drop, so now we're back to that $550,000 purchase price. We're going to now spend all that $30,000 that you've allocated towards a seller credit. We're still assuming a 10% down conventional loan in this scenario. And now the lender's just going to use that money to help really bring that interest rate down. Look what happens to the payment. In this scenario, now we're dropping the payment to roughly $3,300 a month. So again, just another strategy of how can we make the payment more affordable, and we're still using that same $30,000 that you were considering about dropping the house $30,000. Now it's just reusing those funds. It's still funds out of your pocket. It's still going to net out on your closing cost or on your closing sheet. On the closing day, it's still that same $30,000. It's just now being used a little bit different. And I do want to kind of move into category 4, option 4, and that is giving a different scenario, because not everybody has 10% to put down. In this scenario, we're actually showing lower funds to close, meaning that we are reducing the down payment and we are using a different type of loan. So in this case, we're going to use, instead of a 10% down conventional loan, which is shown in the first 3 scenarios, we're going to move into an FHA loan that has a very low 3.5% down payment. In this scenario, without a price drop, we see that the payment actually goes up. Again, we're now leveraging that $30,000 to buy down the interest rate. Mortgage insurance costs on FHA loans are a little bit higher, but what we've now done is we've reduced the funds to close by almost roughly $30,000. So again, well, actually it's more than $30,000 depending on the scenario you're comparing to. This is important because it's not always about payment with buyers. Sometimes it is payment, but sometimes it's funds to close. I share this with you because the strategy behind the lending component is so crucial when it comes to helping buyers see themselves in their particular scenario, buying that particular house. Now, we use this tool throughout our entire mortgage process. This is something that we are pre-qualifying a buyer. We are presenting based on what they're telling us, whether that's payment, funds to close, price point. We're presenting this type of scenario. And then we also use this with our real estate partners because many times they're on the front lines and they're monitoring what's happening in the neighborhood or for their listings. And they want to bring these types of solutions to their sellers and potential buyers out there. I advocate working with a real estate agent and a lender that can help bring the options to life for you, because the price drop may not be necessarily what's going to move it. If affordability is what is holding back your buyer today, we may be able to lead people to see that there is a strategy where they can get comfortable with that house payment. If you have questions, you have a listing as a real estate agent and you want to see what the options would be for that particular house, don't hesitate to reach out. And if you are a seller and you also are watching this video and you're like, gosh, instead of my real estate agent is recommending a price drop, I'd like to see what the impact is if I do a price drop and or a seller credit towards a buyer's closing cost. What does that really bring to market? What does that really do for the buyer? And if you want to see that, Again, don't hesitate to reach out. You can reach us at 480-725-0150. You can email the KellyZitlowGroup at houseloan.com. We can quickly put together this type of analysis specifically for you or your client to help you kind of walk through the what-if numbers and various strategies that could help to move that listing.